All right, Jesse, we're recording, and I'm going to have to apologize to the audio maxis because we are currently slumming it. We're out and traveling around, and we do not have our equipment, so we're just on a mic on the headphones here. But good to see you, man.
Good to see you. Yeah, you guys sound good.
Good. All right, then they're doing a good job. Thank you, Marshall, for making nice earphones and mics. Okay, Lauren, do you have a question for Jesse?
Why have you started your own business?
Yeah, great. Good question.
What
Oh, that
delivery?
wasn't.
What delivery? It's taken 4 years of practice, and you've just absolutely nailed the best delivery ever. Okay, excellent.
It's a fantastic question, and there's several answers to it, I think. So one is that I want to I want to have a profitable business, something that generates cash flows, but I'm not interested in generating cash. I'm interested in generating Bitcoin because that's what that's what I want to have more of. And so, you know, what kind of businesses do that? Well, businesses in the Bitcoin space. So that's kind of a starting point of like, you know, from a capitalist point of view, building in Bitcoin makes a lot of sense, because you can build in a place where the rising tide lifts all boats, so long as you develop an attractive business that customers want to use. So there's that angle. There's that part to it. There's an additional part too of like, Bitcoin only succeeds if we create the products and services that are necessary to onboard the full adoption curve. So, you know, most people only adopt a technology when it's easy and problems have been solved. And you know, it makes a ton of sense in the world to adopt that technology. Like, for example, mobile phones in the very early days, you know, it was this brick that sat in your car, and you had a manual, like you had a big book about how to use this thing, and you probably ran into all sorts of problems with it. And, you know, people don't want to adopt that. Some people did because it's cool and it's new, but it would have been hard to get set up on that. Versus now, you go into a store and you buy the latest iPhone, you plug it in, and everything has been solved, right? It's very easy to do that. And so, you know, it makes sense for everyone to adopt cell phone technology. And with Bitcoin, you know, we're still in the early days. You know, 15 years in, it doesn't feel like it, but most of the world still finds Bitcoin overly intimidating, such that they don't want to touch it. And so there are a bunch of problems in Bitcoin that need to be solved to encourage adoption. And so as a capitalist, there's opportunity to provide services that people are willing to pay for and want. And then you can make more Bitcoin if you do that. So that's just a couple of the reasons. The other, another reason out there is what we're doing in particular is, I think, very cool. And we'll get into what we've done, but in the history of how Bitcoin is custodied, and how all assets have been custodied, there's really only ever been two models, and that's hold it yourself, self-custody, or trust somebody, third-party custody. So you either have your coins in your self-custody setup, or you leave them with Coinbase. And because of multi-sig with Bitcoin, it's possible to have a third model that, in my opinion, combines the benefits of self-custody and the benefits of third-party custody, which there are real benefits to third-party custody. Mostly, you're trusting a company that does this and is an expert in custody, and so there's some assurances there that they're doing it right, versus trusting yourself if you're not technically proficient. So it's multi-sig. Bitcoin's multi-sig enables a very cool new type of custody that I find very exciting, and we're kind of blazing the trail on that. So there's a bunch of reasons. Mostly it's that it's attractive to try to accumulate more Bitcoin by building a Bitcoin business. But also it serves Bitcoin and it's a cool topic.
All good reasons. Thank you for your question.
Thank you.
Okay.
Thank you for starting your company.
Yeah, well, here's hoping we we've done a lot in a year and a half, and I think that we're on a great trajectory to at least be a big part of this next wave of custody for Bitcoin that I think will lower the barriers for a lot of people out there to adopt Bitcoin as part of their portfolio.
Cool. Thank you, Lauren.
Yeah, thank you. Thank you so much. Bye-bye. Thank you.
See you, Lauren.
See you soon.
Yeah, maybe. I'm sure.
I was on what 2 weeks ago, a week ago.
Exactly. You and Andy were on for the end of year review, which was a great rip. Had a lot of fun doing that one, as always with you guys. And of course we touched on the ETF in that particular episode, and here we are still going on. Why don't we kick it off there? Get that out of the way. At time of recording, it's 9th of January. We are expecting, I think the deadline was the end of this week. I mean, it's a moving target, like always.
Yeah, I think it's the 10th. So I think it's technically tomorrow is the deadline for them to reject it. And if they don't reject it, then it's accepted, and then they can launch it on the 11th. That's what I've seen in a few places.
So they can launch it on a Friday, Jesse. What a mess. Oh my goodness.
That'll be Thursday,
that.
But yeah.
Hang on, what day are we today?
Yeah, it's Tuesday today.
Tuesday today. So if it is, so it would be a Thursday, right? Okay,
yeah.
The 11th. Right. Okay. So
but who knows? Maybe it won't happen at all. Maybe there'll be some 11th in the 11th hour. Powers that be will say no. Who knows?
I'm still at complete odds with the whole thing, to be honest with you. I can't figure out whether it's a total psyop and a way to corral people into some kind of 6102 attack in the next 18 months. It was inevitable. I know this. I know it was inevitable that Wall Street were going to finally get in the game. I never for a second thought we would get a 15-year head start on Wall Street, man. This is absolutely incredible. And I remember it was one of the pivotal moments in my epiphany journey down the rabbit hole when I was looking into Bitcoin and in other investment strategies and assets and whatever else. It's like, oh wait, there's this thing that there's an investable asset out there that Wall Street didn't design. I'm in.
Yeah.
That was one of those like massive sat drop moments.
Yeah, that's such a good point. I mean, in the history of finance, there's only ever been assets that existed before the finance and assets that were created during modern finance and engineered by those people. Literally never an asset that has been created post modern finance that didn't involve modern finance creating it.
And
that
look
I can think of.
No, there isn't, man. I mean, like look at gold and what a mess the gold market is with all of the derivatives and paper and whatever else that is on gold. And every year there's something else that comes out that, my career was in foreign exchange options, right? Foreign exchange options didn't exist in 1975.
Yep.
I don't think they even came into existence until like the mid to late 80s, if I remember my history correctly. And then once they're in, they just get even more and more complicated to understand.
Yep.
Then you have exotic options.
Right.
So you have vanilla options and exotic options. And then you have all of these different kind of structures that you can set up, spreads. And then I remember the big craze of going into long date options between 2 out to 30 year. I'm like, who on earth is doing like 10-year options on dollar yen or on euro dollar? And as we now know, some of these fiat currencies might not even be around at the point of expiration. And the thing was, I remember thinking the people putting on these trades, they're not going to be in this chair until expiration. So like they literally don't care. This is purely speculation.
Yeah. Yeah. And you know, your corner of finance is a great microcosm of it. But that's happening and has happened everywhere in finance. I mean, debt lending has become extremely exotic. Mortgage-backed securities, you know, derivatives, each of these landscapes is unbelievably complex. And I only know enough to recognize that they are complex. There are entire worlds of where the people in them don't even fully understand all of the nooks and crannies that have been created in that financial space, which all has amounted to just a expansion of how many on paper assets are out there floating around in our financialized world.
I love the idea, this term quant, the quant traders, like the idea that these guys are the biggest brains that ever lived, and they're the ones looking at the all of the figures and the numbers and the spreadsheets, and it's like, guys, just stack sats, stay humble. That's all you needed to do. The last 15 years was be the dumbest kid on the block, just stacking away, and you've beaten everybody hands down.
There is this myth that our society likes to latch onto, and something I've written about a fair bit with the yuppie elite piece in particular. But we like to believe that there's somebody who fully understands everything. You know, so there's some like whiz out there who sees all the angles and really grasps everything. And that's like the myth of the quant, really, is that this guy knows. But nobody knows. Some people are faster calculators than others, but you know, the smartest people in the room are caught up in the details and are not able to zoom out enough to see that it's all a house of cards, and there's a really simple answer that's not this house of cards.
Absolutely, mate. All right, so Onramp, let's talk about it. What you've told Lauren here, the impetus for getting into it, but for those that are listening that quite don't understand the offering, what is Onramp? What do you guys do?
Yeah, so Onramp is a Bitcoin asset management platform built on multi-institution custody. And so let's unpack that, I guess. So this is all about multi-institution custody at the end of the day. And that's a little bit about what I was telling Lauren about. The idea here is that with multisig, with Bitcoin's native properties of multisig built into the protocol, you can have a vault, a wallet, controlled by multiple keys. So, you know, the classic is a 2 of 3 setup. So you have 3 keys that control a wallet, and you need to have 2 of 3 of those keys sign any transaction in order to effect control on those assets. And so that's a fantastic setup for self-custody historically. This has been this model has been developed and proven out for individuals using it for self-custody. And that's what Unchained and Casa and a few other providers have done a great job of commercializing and proving out over the last half decade in particular. But it's possible to take that model, the multi-sig model, and say, well, I don't want to, you know, you don't necessarily need the end user, the holder of the coins, to use multi-sig in a self-custody setup where, you know, with Unchained or Casa, a user holds 1 or 2 of the keys, and then typically 2 of the keys, and then the Unchained or Casa or whoever they're working with holds the 3rd key up as a backup key, really. And so that model is collaborative custody. It's fundamentally a self-custody model where the user has to participate in that. And that means that the user has to get comfortable with cryptographic materials and holding cryptographic keys and setting up a hardware wallet and interfacing with, you know, a multi-sig user interface. And that is a little scary for some people, very scary for some people, less tech savvy folks, that it's a bit of a non-starter. It also is a problem for institutions, for organizations, where let's say you run a company and there's a board of directors. Well, who's going to set up and maintain the self-custody arrangement? Because are you going to pick one person in that company to set up and maintain your self-custody multi-sig arrangement? No, it needs to be, it needs to fit that model of having, company approval before moving assets, rather than an individual unilaterally being able to. Anyway, so there's some challenges for certain users fully adopting multi-sig for their self-custody. And so what Onramp has done is to take the multi-sig model and make it so that instead of the end user having to participate in that arrangement, they don't. And that's because Onramp has partnered with 2 other institutions to hold keys on behalf of the end client. And the way this works, and I realize this sounds a little bit of antithetical to the self-custody goals and mantras of the Bitcoin community, but bear with me, and it'll reveal itself here of the significance of this for some people. So Onramp has partnered with BitGo and with CoinCover, 2 of the leading, BitGo, Mike Belshey invented multi-sig for the Bitcoin protocol, and BitGo is the leading infrastructure provider for the whole industry. It's the stuff that is working on the back end for a lot of exchanges in particular. And CoinCover is a dedicated expert in the UK of holding keys in multi-sig arrangements, and has built a business on doing that, and being a partner with BitGo. So, and then Onramp holds the 3rd key on behalf of our clients. So we have this custody solution where an individual or a business wants to hold Bitcoin in the Onramp multi-institution custody solution, and they onboard with us, and we use our private key that we've created in best-in-class way, BitGo's private key that they've created and maintain in best-in-class way, and CoinCover's as well, to create a multi-sig wallet that is dedicated for that end client. And the beauty of that is that the end client maintains control of that arrangement, because Onramp cannot move any of those funds without the client. BitGo can't, CoinCover can't. It requires multiple signatures to move any funds in that wallet on behalf of the client. So that takes one of the big advantages of self-custody, which is that the end user maintains control. And it also removes some of the probably the biggest problem with a third-party custody, which is that traditionally a third-party custodian has control of your funds. And so that leads to some of the problems of rehypothecation, or the FTX scenario where people thought they had their coins here and in fact they didn't. That's not possible with this model, because only the client can direct the key holding institutions to move their funds on their behalf. And so there's a whole regimented process in place that manages that whole transfer request process. So the result of that is this new type of custody, which is multi-institution custody, where and this goes back to what I was telling Lauren about, that it has the advantages of self-custody and the advantages of third-party custody. And it also mitigates the risks or concerns with self-custody, specifically the concern that maybe you set it up wrong, or that you're not storing your cryptographic materials correctly, or maybe not maintaining perfect security constantly, which is what you have to do with self-custody. So it mitigates that risk, because companies whose entire business it is to do this are doing that. And even if there was a compromised key in that arrangement, it's still not sufficient for your funds to be stolen, because no single key has unilateral control in this arrangement.
I guess
so. You've mitigated.
Sorry, just one to add, which a lot of people are talking about recently, because I'm not sure if you guys are aware, but in Sweden, there's been reports of people having their houses broken into, tied up and tortured until their Bitcoin is given up. So it would mitigate that risk as well, right? If you literally cannot get to it, or right, give me your Bitcoin. Okay, well, I've got to make 2 phone calls to get that done. And it's now 3 a.m. there and nobody's going to answer the phone. So what are you going to do, Mr. Torturer?
I'm really glad you mentioned that. I was forgetting about that very important benefit of this model, which is it mitigates the risk of a wrench attack. And no solution is 100% perfect, right? But we can talk about orders of magnitude risk reduction, and I think that this model achieves that for specifically the wrench attack, where an attacker comes in and ties you up and is demanding your coins. Well, we've set up this model where you can't move your coins it takes about a week. And you have to deal with multiple companies and go through the approval, the authentication process that you've agreed on and is established for you by these companies. And you have to go through 2 of them, right? Because you have to go, if you're in the typical scenario, you're going through the Onramp authentication process, and we sign, and then we facilitate you going through the authentication process with our partners at BitGo, and then they sign. But each of those is its own dedicated set of authentication steps that take time, and together that takes a week. And if you're in duress, and that becomes evident at any point in that week-long process, well, we will hold off on signing because of that duress.
And call the local police, please.
Well, yeah, right.
Alert my local gendarmerie.
Yeah, and so of course you can come up with scenarios where that wrench attack could still be successful, right? But it makes it a whole lot harder than if you are holding 2 hardware wallets at your home, and it's a multi-sig wallet, but you have set it up in a way where you can access it easily, and then an attacker comes in and can benefit from that ease of access in that scenario. So that's another huge area of concern for self-custody that this model mitigates. And then of course there's the risk mitigation of all the concerns on the third-party custody side, the classic custodial concerns of rehypothecation, of hacks. So it's not possible to lose your coins in Mt. Gox in this scenario, because there's 3 institutions that are holding 1 key each. And if one of those keys was compromised in a Mt. Gox type scenario, well, the other 2 keys can cycle out that compromised key. And so again, that's a scenario where if multiple institutions were hacked at the exact same time, and these meat space protocols for proper key management and cold storage were somehow also hacked during this compromise, there's a scenario where it's possible that you could have a compromise. But we're talking about orders of magnitude less risk than just trusting your coins to Coinbase, where you have a single point of failure, and you also have a single point of confiscation in the event of like a 6102.
I was going to ask you about. I'm glad you brought that up, because I was going to give you a little bit of pushback and say, well, what if in the event of a 6102, where in the States, they come to all of you guys, they come to those three companies that you've just mentioned and say, right, give us your keys because we're taking everything.
Yeah. So obviously this is a very real problem, or concern for any company that's operating anywhere, because
and perhaps sorry before we get into this, we're just assuming the listeners understand what Executive Order 6102 was. We should actually lay that out first. If you want to go ahead and explain what Executive Order 6102 was and why we as Bitcoiners should be very wary of it.
Yeah, I'll tee it up. You can take the wary part. So 1933, is that right? Executive Order 6102 effectively said any U.S. citizens who are holding gold, you have to turn it into the government. We're taking your gold. And obviously that, is pretty infeasible for the government to collect gold that was, buried in the backyard. But it was very feasible for the government to go collect gold that was at the local bank vault. And so I guess that's a good segue for.
Yeah, exactly. So the idea being that this is a threat that the government could turn around, and 6102, they could say, right, everybody needs to turn in their Bitcoin. Now, if you're going to be a very good little citizen and go along and sign your private keys and hand in your hardware wallets and whatever else, then good for you. If not, you want to be in complete and utter total control of those coins, self-custodied in a hardware wallet or some other form, maybe a paper wallet or whatever your setup is, or a multi-sig across several devices that is in your control. Because, are they going to go door to door? I don't know. Like you said, they didn't go door to door, but digging up people's backyards because they didn't know they had the gold. Chances are they're going to know who has the Bitcoin, because a lot of us have bought from KYC'd exchanges. So when this day comes, there better be something in place for you to be able to protect your funds. So if we say some of the plebs are listening to this now and they're thinking, all right, X amount of my stack, perhaps I should look at a multi-sig solution like Onramp, not multi-sig, excuse me, what do you call it?
Multi-institutional custody.
Multi-institutional custody. So maybe there's a pleb out there thinking, maybe 10 to 15% of my stack should be, untouchable like that. Are all the companies that you're using, are they all listed in the US, or are some of them listed outside in other jurisdictions? Like how have you thought about this in-house?
Yep. Great question. So this is an area where we are confident that today our solution is probably an order of magnitude harder for the 6102 to be executed against us versus Coinbase, where there's a single entity that just has to receive an order from the government, and then they have to follow it. Currently, so BitGo is in the US. We are in the US. CoinCover is in the UK. And so we have a quorum in the US. However, for that kind of action to take place, we would have to, both of those companies, BitGo and Onramp, would have to receive that action on the same day, with the same language, the same requirements, targeting the same assets that would be very hard to figure out what are the assets that are held in these particular vaults. So it'd be a lot harder than the government writing a letter to Coinbase saying, give us all your assets. But still doable, right? But we have a line of sight, and we're working on this to have additional key options internationally, and so then that becomes the model that we're working towards. So right now it's I'd say an order of magnitude harder for 6102 versus a traditional third-party custodian. And soon, I think probably 2 orders of magnitude harder. So that, that's how we're thinking about that. And again, this comes back to the reality that no solution is perfect, but you can reduce risk radically by finding the right balance of these options. And I think you raised part of how this ends up practically mattering to the audience, which is we've had a lot of our early clients have come in because they have self-custody set up for their entire stack, and that is worrisome to them, right? You don't sleep at night because of those edge case worries about if I die, will my family be able to retrieve the Bitcoin that I've set up in the self-custody treasure hunt, or if in the 6102 scenario, if they know that I bought coins on Coinbase a half decade ago and they come knocking and they demand those coins, what am I going to do? Like, I have to turn those over, versus having some sort of diversification with how you're custodying your Bitcoin. And so it's been very interesting and exciting that, a lot of our early clients have been thinking about that and have been worried about that, and, come to us because they have quite a bit of Bitcoin, and they want to make sure that in a disaster scenario, their family will certainly receive some Bitcoin, even if they don't manage to figure out the self-custody or somehow that gets screwed up. So we've had quite a few folks who are interested in putting 20% of their stack in a multi-institution custody arrangement in order to diversify how they're holding their coins. People who, it hasn't historically made sense to them to give their coins to Coinbase or any other third-party custodian that has unilateral control, given the track record that we've seen with anything from Mt. Gox to FTX to, even in the last year, Prime Trust and Fortress Trust being notable examples of funds being lost because of hacks or because of mismanagement. And so people know enough to not trust a single institution with unilateral control of their funds. But this model solves for that and makes it viable for people to diversify out of self-custody into self-custody plus multi-institution custody, in order to have a little bit better peace of mind that you don't have all of your eggs in one basket in the event of a disaster.
And you could even go so far as, if you're going to do something like 10 to 20% of your stack, when you send that across, you could run that through a CoinJoin service beforehand and then across to the institutional multisig, which is an extra layer of obfuscation.
Certainly could, yes.
So are you looking to partner with a few other companies and, outside of the US jurisdiction? Is that kind of the plan for the next 9 months? And if so, who should get in touch if they're interested in helping you guys out?
Yeah, that's a fun angle. Yeah, so we're constantly talking to people who have, and companies who have heard about this model and are interested, usually for their own purposes of there's a lot of companies out there that have the same problems that I was speaking about earlier of how do you hold your Bitcoin on your corporate balance sheet, because self-custody ultimately means one or a few individuals having control, versus this model where you can set up your permissions to be in line with how a typical institution does things, having a whole access control list or board of people that have to approve something. Anyway, so we've been talking to quite a few businesses out there, and if any international businesses who specialize in Bitcoin custody and are familiar with multisig are interested, we'd love to talk with more about finding the right partners for the next iteration of our geographic distribution multi-institution custody model.
And who's on the team with you, mate?
Yeah, so I started this with Michael Tanguma, who was previously at Unchained and helped really scale that business. So Michael was seeing this problem from the kind of the opposite side of where I was sitting. So I was running an altcoin hedge fund in 2017 that when I still believed in altcoins, and then the market taught me the hard lessons, and I became Bitcoin only, and that meant converting my fund into Bitcoin only. But then I'm running an investment fund that's just a Bitcoin holding fund, and I know that I had an obligation to tell my investors, you guys don't need me. You can take self-custody, and you should, because then you avoid paying fees for me running this fund. And a quarter of them did, and 3/4 of them didn't want to deal with it. A lot of these were baby boomers or folks who just hadn't gotten familiar with private keys and key management in general, so they didn't want to touch it. So I was running a Bitcoin holding fund on behalf of investors, and there was value in that, and in particular in my monthly updates to them about why they should still be holding Bitcoin through all the volatility. So there's value for them in that. So that's what I was doing. Michael was helping build Unchained and onboarding a bunch of capital to multisig self-custody. And so he was experiencing the kind of the other side of the coin there of, there are a lot of people who were curious about multisig, but ultimately didn't feel comfortable taking on that responsibility of setting up their own arrangement and having to maintain perfect security indefinitely. Because a lot of people, when it comes to tech, are aware that they don't know everything, and so they have like a healthy fear that they're going to screw something up. And that's frankly a good instinct to have when it comes to this stuff, because screwing something up is unforgiving. So that he was experiencing that, and then we were talking about how there should be a better way to hold Bitcoin and leverage multisig without having to participate in it. And then this model came out of those conversations almost 2 years ago. So that's the journey we've been on. And so Michael and I founded it, and we've since been able to excite quite a few Bitcoiners with what we're building, and bring them in to help us build this business. So at this point, we have a solid team of veteran Bitcoin industry folks who have experience, on the engineering side, the sales side, the operation side, from a variety of different companies in the industry. And yeah, we're excited about really scaling into the halving and everything that's happening with ETFs, and what I think will be a pretty big year for Bitcoin shifting into the mainstream. And then when that happens, this problem of custody becomes more salient. It becomes more acute for everyone who's holding Bitcoin or thinking about how do I go from, okay, I've decided I need an allocation to Bitcoin, from that point to how am I going to store this and feel comfortable sleeping at night. So, we're excited about 2024 as we keep building this model out. So it's a whole Bitcoin asset management platform built on multi-institution custody. And that means that we have our custody product for existing holders of Bitcoin who are looking for a way to either completely shift or at least diversify how they're holding their Bitcoin. We also have a private placement investment fund that is designed to be the best investment fund out there for getting exposure to Bitcoin without holding it yourself. So, if you have dollars and you're looking to get into Bitcoin, and you're not yet ready for self-custody, this is a great stepping stone, specifically because it allows for in-kind redemptions, which none of these ETFs allow for now. They were going to, and then they caved on it. But because this is a private placement grantor trust, this allows for it. The public market stuff doesn't allow for it. Private placement does allow for it.
Can you explain that to the layman?
Yeah. Sorry. So that is some investment fund terminology. So a typical investor here would come into the trust, go through the onboarding process. It's for accredited investors only. So that means folks who typically have a net worth of $1 million or more. And they send in dollars, and we buy Bitcoin on their behalf and then store it in a multi-institution custody wallet. So that's the same custody arrangement that we've been talking about. And then eventually, if that investor wants to take self-custody, they can, which is different from GBTC or any of these ETFs now, where they are set up to allow dollars to come in, then they buy Bitcoin for you. But if you want to withdraw your money, you have to convert those ETF shares into dollars. So you have to go into dollars in order to get your money back. And that's a problem because it creates a taxable event.
Yep.
So anybody who's investing in Grayscale or in these future ETFs, if they ever want to take self-custody, they have to incur a taxable event. And so that means you have to fork over 20, maybe 30%, depending on your state and circumstances, just to get out and then go go use your dollars to buy Bitcoin, and then you're in self-custody. Versus our model, which allows, because it's a private placement grantor trust, just technical investment firm classifications, this model allows for in-kind redemptions, meaning you can take Bitcoin out of the fund, and those in-kind redemptions are not subject to a taxable event because of the specifics of the IRS classification of grantor trusts. Basically, they were always your Bitcoin. They were just sitting in a trust. So if you take your Bitcoin, there's no taxable event. That would be the layman version of it.
Perfect.
So that's very different from any of the Bitcoin holding funds out there, Grayscale and the ETFs. And we also have the multi-institution custody arrangement, which none of the other ETFs or Grayscale do. And in fact, there's plenty of speculation about Grayscale. Do they rehypothecate coins? Nobody knows. They might be doing that. They might be lending out assets in the trust or using those assets for other things without the end investor knowing that they've done that. And that's not possible in this model because of the multi-institution custody setup, where none of the key holders have unilateral control of those keys. So you can't lend them out without authorization from the investor. So anyway, those are the two big distinctions on the fund version of our product that make that fund better than anything that's out there currently. So for anyone who's interested in a stepping stone into Bitcoin, that is, I think, the best way to do that right now, short of taking on self-custody or buying coins on Coinbase and leaving them there. This is a better way to do that currently. And then so to complete it, there's the custody product, the fund version of it, and we also have a product for wealth managers, for RIAs, to allow those wealth managers to help their clients get exposure to Bitcoin, all under the umbrella of that wealth manager's relationship with their client, so they can ultimately bill on those assets versus having the client go outside of their relationship with the wealth manager and not be able to bill on it. And Andy Edstrom is leading that product for us.
Good old Andy. Another shout out for Andy.
Yeah.
Love it. So you did mention as well something that I'm sure the plebs would have picked up on. Best, what was the way you termed best of class key, not management. How do you produce the keys? Like, how are you? What you've obviously geeked out on the entropy and all that kind of stuff. So yeah, explain to us the rabbit holes that you were led down and how you do it, or is it just literally you and Andy sitting around on a Wednesday night with a bunch of dice and some paper?
That would be funny. No, it's not that kind of model. So it is a whole rabbit hole of how do Bitcoin businesses set up their keys and manage those keys. And it's a rabbit hole that comes with certain opaqueness to it, because nobody really wants to talk about how they do it. And so I will also keep things a little bit ambiguous here, but suffice to say that there are I don't know what institutional grade products out there for setting up your own keys. Effectively, what a super tech savvy and paranoid pleb might do with air gap computers and ephemeral operating systems and sharding keys. Those are kind of best practices out there, and that's part of how you approach it, and you set up your own corporate policies for how that process is run, and then also your internal controls for who has access to what and how is it physically and geographically handled, in order to make sure that it's impossible for that to be compromised, because you've done it in an offline manner, and also because you have established these controls and processes that make it so that the material is not in one place at one time, and that's a big part of the equation. And then that's just for setting up your keys as a company. This model has the added benefit of that is one of the keys in a quorum. And that is huge because if any of the three institutions' key management systems was somehow compromised, that's still not sufficient to create any risk for client funds, because no single institution has unilateral control, since they each only hold one key. So multiple levels. There's quite a few layers of security that have been thought through, and best practices from how other companies approach this have been leveraged and then modified to suit our particular circumstances. And, you always want a little bit of variation from the theme to, make sure that your particular internal processes and controls don't perfectly match other companies out there, but, you're using the same technology and best practices ultimately.
So you started this 18 months ago. You came at it as already a Bitcoiner, a maxi, a pleb, somebody that had put a lot of work into the space with your writing as well. You'd managed the funds and so on. What have you learned in the last 18 months that's like blown your mind the most? Because we're always relearning things as we go in through our Bitcoin journey. What's been that thing, that area of Bitcoin that's just pulled you in for whatever reason?
Yeah, that's a fantastic question. I guess there's a couple pieces that jump out. So I guess first one is from like a Bitcoin industry perspective. It's earlier than it feels. And I think for plebs out there, you see all these businesses that have established brands, and you think, oh wow, like it's all been done. People have been doing this, but the reality is like people are building these businesses still, like and scrambling to figure out how they're going to build the next feature. And so I think that has been a surprise of like, oh, this is a very fast paced building environment and industry. And there are sort of incumbents at this point, or, but they've really only been around for a few years themselves. And they're all still in this grand scheme of things, early stage startups. Early to middle stage startups, at best. BitGo's been around for 10 years, and I guess you'd call them a medium to late stage startup. But yeah, so there's that from like an industry point of view. Yeah, and then I guess also sort of related to that is how quickly so I was a management consultant and before I ran that fund. And so I've been out of the game for a half decade. And the amount of tools that have made it possible to be more productive in a startup environment that I was not aware of or didn't exist or weren't really commonly used even 5 years ago is pretty remarkable. So the startup world is faster paced than I thought it was 5 years ago. So it's another wrinkle in it all. But then the final piece I wanted to say was like, everyone is still trying to figure out mastery of this asset in every dimension. Like, we talk to pensions or wealth managers, sophisticated finance professionals who know less than your average Bitcoin pleb about Bitcoin and why it has value, how it fits into a portfolio, everything about it. And as a pleb, that, you believe that, but then it's another thing altogether to be on a call with like a very sophisticated firm and realize that they don't know anything yet about Bitcoin. And so it's remarkable to see that. But this also extends to every level of learning about Bitcoin. There's plenty. The vast majority of firms and people are still at square one and know nothing about Bitcoin and still need to have their eyes opened to why this is an attractive asset to hold. But even individuals and companies that have decided, oh, Bitcoin is digital gold, and I'm super excited about it, and I can't get enough of it. Those people still don't have their custody set up or thought through, or are still working through various levels of FUD about their own conviction, even though they're super excited. So I think that's probably the most stunning part about being on the industry and talking to prospective clients or partners, and realizing how early it is for everyone in the industry, and especially in TradFi, still trying to figure out what to do, how to make sense of this, and where to turn to.
Yeah, and it's so humbling every single time. I mean, just yesterday, the Standard Chartered FX researcher dropped his piece, right? Which is interesting. I've managed to get in touch with him, and I hope to have him on the show to have the discussion
that'd be cool
about this. Wouldn't it? I mean, it'd be so cool. I just want to know, what one, were you mandated to write this, or are you a pleb? I want to know that. And I've had Brian Consolvo on the show. We're just waiting to get clearance to drop that one from KPMG internally, because he wrote about Bitcoin and the ESG narrative earlier this year. And again, why? Where is this coming from? But we are so early. And I know it's such a classic meme. We are so early. I can't drill home enough to people how early we are. And listening to you talk about this, you're building a business and you're like, huh. And you already knew we were early, but that just
Yeah. And I've talked about it a lot. I've written a lot about it, about how damn early we are. And, that my math points to $10 million per Bitcoin in today's terms, over, end state over the next few decades. And also, I've dug into where we are in the adoption curve. I think it's way earlier than people typically think. I've been noticing that with the ETFs, there's been a lot of people posting on Twitter about sort of mourning the fact that we're exiting the early adopters phase, that we are crossing the chasm. And these are classic adoption curve categories. That you go into the middle of the adoption curve, and now you're dealing with the early majority. But that's wrong. We're not at early adopters.
No,
we're still in the innovators phase.
Exactly
the very
that.
First little bit.
Exactly that. We're still in the innovators. Right there.
And people. And it's so easy if you've been in Bitcoin for 10 years to perceive what's happening as wow, we've really arrived. It's really going mainstream. So it only makes sense that we're in the, crossing the chasm to the bulk of the adoption curve. But no, we're just so early. And if you've been around for 10 years, it's understandable that it's hard to wrap your head around just how early you are. So you sort of assume you're further towards the middle. But if you adopted it 10 years, you were at that edge of the adoption curve where the line melts into the x-axis. So you can't even tell that there's any adopters at all. That's how early you were. So surprise, surprise, we're halfway through the innovators phase now. But you perceive that growth as we've made it to the middle, to the bulk of the adoption curve. Nope, we're stupid early still.
Yeah, I 100% agree. All right, so you're a business. You got to make money. You got to keep the lights on, keep food on the table. What's the business model?
Yeah, so the business model is, we charge fees on custody, and that is a percentage of your assets. Depends on how much you're custodying with us. It's a tiered rate.
So is that paid? So does that track the amount of the investment over time, that percentage, or is it fixed? How do you work?
Yeah, so up to a certain valuation, we charge X percent, and then above that, we charge a reduced rate. It like a tax bracket system, how that would work.
So if Bitcoin moons you're going to end up paying a little bit extra on the, is it yearly?
Yeah, it's a yearly rate that we charge, along the way. But yeah, in that scenario of Bitcoin moons, clients will end up paying a lower effective rate than they started with, but higher nominal fees in dollar terms. That's just how that would work out.
But but the fees are paid in Bitcoin?
Yeah, the fees are paid. The fees are just deducted out of the balance. And yeah, so this is a bit of a departure from how other companies have approached custody. Third-party custodians have approached custody as it's free, but you got to wonder, with a free product, why is it free?
Which brings us to like what's going on with the ETF filings at the moment, and they're all updated. There's a fee war. There's a fee war going on, and I think what a BlackRock down to 0 now. Is it that ridiculous?
Was that right? I saw 20 bips yesterday.
Okay, because I saw ARK come out with 0.25 today. So yeah, they're really trying to be so.
Yeah.
But how? And Caitlin
Long had a great tweet about this.
Yeah, where is it? Let's read it. Hang on. Damn it. I thought I had it saved because I wanted to bring it up with you.
Yeah, I retweeted it yesterday, so you could find it there.
Sorry, listeners. Here we go. Caitlin Long. Okay, so so it was ARK just dropped their fee to 0.25%, filed 20 minutes after BlackRock's. So I'd still like to know what BlackRock went for in the end. But anyway, so Caitlin says, when fees are lower than costs, please ask yourself how the asset manager is making money managing the fund. With no fee funds, the answer is usually securities lending, a practice that can pose a lot of hidden risk to investors. What's really going on here?
Yes. Caitlin nails it here. And I wrote, when BlackRock first came out with their proposal, their S1 in the spring of 2023, I did a deep dive into looking through all the terms in there and identified a few major concerns for people who want to preserve their property rights with regard to Bitcoin. And that was one of them. That a standard practice in the ETF world is that the ETF has the right to lend out the assets in the fund. So that's rehypothecation. So, in the Bitcoin scenario, that would mean, let's say BlackRock is holding a bunch of Bitcoin, and they could, through backroom deals, lend that Bitcoin in the fund to short sellers or whoever for short-term purposes at an interest rate. And so then that means that the BlackRock has now added a revenue stream because they're holding all of these assets on behalf of the ETF investors, but they're able to lend out those assets that they're holding on behalf of ETF investors without the ETF investors knowing or approving of it. They can lend that out and get an interest rate. And that's all nice and good, so long as you don't have an FTX scenario, or, the party that borrows it pays it back in full, and does so before there's a bank run on the assets in the ETF. So that's a big hidden risk, and it's part of why ETFs have such low fees. The reason that ETFs have such low fees is because a part of the business model that makes it possible for this to be profitable for the ETF provider is they're lending out those assets.
And I've just checked. So some of the players are coming out. Decision by regulator expected on at least one application by tomorrow. Bitwise is waiving fees for the first 6 months or until it reaches 1 billion in assets, with a subsequent charge of 0.24% afterwards. ARC waive fees for first 6 months and then 0.25% afterwards. BlackRock's fee is finally this fee is, but right, okay, so they were going to do 0.2% for the first year or until $5 billion in assets.
Right.
And then it would move to 30 basis points. Yeah,
yeah,
0.3%. Wow. This isn't this isn't normal.
It's right. It's not normal. I mean, I guess it's sort of normal for ETFs to have crazy low fees, but the hidden reason is because it's either viewed as a loss leader for the business, like, you know, they want to ingest all this capital so that they can sell other services to those investors, or it's because they don't really need to make money on the fees for the fund because they know that they're going to make a lot of money by lending out the assets in the fund. And so either way, it's very unattractive to the end investor, but it's just obfuscated. And so people don't realize that that's the deal that they're making, the deal with the devil that you're making when you enter an ETF.
And imagine the sales guys at BlackRock, man, like in 6 to 9 months time after the halving, and you're going to get all of these phone calls about rebalancing your portfolio. Or did you realize that your Bitcoin assets now, they are that much, but why don't we take some out of that and put it into one of these other 5 great, amazing funds that we also run? It's just an absolute, it's awful. It's den of vipers that people are walking into. So
yes,
plebs already know. Anybody listening to this show already knows. If there's anybody new here considering buying the ETF, please don't buy the ETF. Go and educate yourself, get some Bitcoin privately if possible, and take self-custody of it, and just, you know, enjoy the next 3 to 5 years learning about Bitcoin. And like we said, you're so damn early. Don't bow to FOMO. It's madness, man. What's about to happen?
Absolutely. You know, if you're listening to this, you probably know enough to be wary of these ETF products. But yeah, don't buy these ETFs. Frankly, if you're listening to this, you're probably comfortable enough with self-custody, and that's what you should do. You should, if you have the confidence and technical know-how to take on self-custody, great. That's the path for the plebs to take. And, you know, the reality is plebs are typically younger and tech savvy and sharp, and they can figure it out.
And then we have this classic narrative, right? You have to diversify your portfolio. It's like, no, you don't, right? You've got the thing, you have the asset. Like, you know, let's always remember as well, you know, bet the farm, right? This is the time to bet the farm and bet the farm on Bitcoin. But how do you diversify within Bitcoin? And this is like what you guys are offering, right? So what can you do? Okay, you can diversify by having some on a Lightning wallet, so you can use it when you're lucky enough to come across a bar, restaurant, or cafe or something that is accepting Bitcoin. You want to be able to support that business. You can diversify across different hardware wallets. Maybe you've got some in geographic locations, maybe different devices as well. You can diversify with a non-KYC stack versus a KYC stack, or you can rotate out of one into the other. And now you can diversify with like
multi-institution custody,
which is more like, I'm kind of leaning more towards thinking about this, what you're offering, as more inheritance planning as well.
Yes. I should mention that, you know, that's what a lot of our early customers have been very interested and excited about. So we have built that into our product. So, you know, and that's missing out there. Certainly not a part of self-custody, and most, you know, third-party custodians aren't really building that in. But, you know, we view this as a generational asset, and we understand that Bitcoin holders, people with significant holdings, view it that way too. And so we've built in inheritance planning into our product. And you in several different ways, several different tiers of it, really. So if that's a concern for you, if you're thinking about, well, I've got a few million in Bitcoin, and I want to make sure that I've set up inheritance, and that goes off without a hitch, talk to us. We'll let you know what we've built and see if that's interesting to you.
Yeah, absolutely. And if you don't have a few million in Bitcoin, you soon will.
Yeah, right.
So get ahead of the curve,
Yeah.
and perhaps testing out the service that you're offering with just a small amount of your stack. Don't go crazy.
Right.
Get comfortable with the service. Get comfortable with the team, and you got to be. I mean, as someone that might look at this
and I should have
service,
said, I was thinking, if you have a few million in Bitcoin and you want to make sure that some smaller portion of it, a few 100,000, is set up in a way where you're confident that it goes off without a hitch, then talk to us. We, our minimums are not several million there, several 100,000.
And you got to be comfortable with the fact as well that here's the thing, Jesse, are you going to be doing this for the next 50 years? Right. That's how have you thought about that in your mind? Because obviously things change, people change. But if you're going to be, custodying people's Bitcoin for them, this has to be, you've got to be the guy there with the gray hair in 50 years time, talking to the grown-up kids of the people that came to you in the early days.
Yeah. Yeah, that it's a good point. And that is part of the advantage of building a business, because the business is immortal. The business is indefinite. And like if you had a Bitcoin inheritance guy who helped you do this, you're only, that continuity only lasts until they retire. But when you have a relationship with a business whose interest is in perpetuating itself, then you have a relationship with an organization that is made up of people who may or may not cycle in and out, but the actual business relationship is with the organization, and that is indefinite and immortal. And yeah, I mean, personally, I'm heavily building right now, and absolutely there will be a time where I start to shift that into less heavily building and more, hopefully more of a gray hair role or advisory role, longer term. But that's the point of setting up a business where the relationship is not with me as an individual, because I could get hit by a bus, but with an organization that is made up of many people.
Mm-hmm. Man, I think it's a winning idea. I think there's obviously need for it. Otherwise, you wouldn't have had customers through the door already. Where do you see the next 5 years? Do you need to do the classic, we need to raise money, we got to have this amount of people so we can hire this person, that person? Can you bootstrap it? Like what's been the journey so far, and what's the next 5 years?
Yeah, so it started with some bootstrapping, but pretty quickly, people got excited about it, and our early clients, some of them are rather successful or have been holding a good bit of Bitcoin and are excited about helping to grow the next cohort of Bitcoin businesses. So we've had investment from our clients who are excited about what we've built and want to be a part of it too, which has been really cool. So we will continue to scale that. In terms of where I see it's interesting, because Bitcoin custody is such a slow moving adoption thing. Like you inherently, people want to wait and see how things develop for an approach to custody and for a particular business. And that's realistically what happened with Unchained or Casa as well. How do you build that trust over time and then become trustworthy, frankly, just by Lindy, by being around, by continuing to build. And so we've seen that already, where it's a long sales cycle for us of people want to get to know us and think about it more and personally think through, okay, what are the scenarios for me? What are the ways in which this could go wrong? And frankly, we've seen that people who do that, who go through the necessary time to just let it to mull over how they're approaching custody and what our product is, eventually realize like, oh yeah, this should be a part of, or I want this to be a part of how I'm approaching custody, because the advantages of it are pretty great, and the risk mitigation of it is pretty great. So that's kind of the pattern that we've seen, and we're the path to success for us is to just keep doing that, to keep educating the market about multi-institution custody, because who's out there talking about it? I mean, there's a couple other companies that have set up similar products, but I don't think as robust as what we've done. And that's because we are a multi-institution custody company, and that is our focus, rather than this being like a bolt-on to a separate focus. So that
I've just thought of another possible scenario
Yeah.
where you might be able to help out with Plebs down the line. We are facing, let's say the next 3 years, there's the pump comes in and the numbers all go green, and people are going to be in a position where they can make a significant life change. And whether that's buying the 40 acres of land that you want for your citadel and your cows and your horses and whatever else, or the beach pad with the 5 bedrooms and the swimming pool, and just be done, right? You don't want to touch banking, you don't want to get fiat loans, you don't want to do any of that stuff. But when it comes to purchasing the home with Bitcoin, and you're going to be buying from a bank because nobody owns their own shit anymore, right? We already own nothing, we're already fat and angry, so they're going to want proof of funds. And if my proof of funds are for this house that I desire from 3 well-known businesses in the US, that kind of like it's tick, 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 right? That's going to help me or any other discerning pleb out there out, because now the proof of funds for the home are coming from BitGo, 15-year-old long company or whatever, or Onramp, or what was the other one? Sorry,
CoinCover,
and whoever else you might have in the stable by that point.
right?
Which is interesting to think about longer term. It just crossed my mind.
Yeah, that's right. And that's why we ultimately view this as like it's a Bitcoin asset management company, and it's centered around multi-institution custody. But Bitcoin asset management means a whole array of products and services that are tailored to the particular needs of Bitcoin holders. And so that's where we eventually are taking this. But it starts with this better form of custody, or at least this option for custody. And I frankly think it's a better form of custody for 80% of people, or 80% of capital. It just so happens that people listening to this show, I think, are disproportionately in that 20% where self-custody is probably a better solution, because people listening to this show have learned enough about Bitcoin, or tech savvy
but people
enough.
listening to this show they're orange pilling a lot of people, right? And
and
this is the thing. This is one of those barriers that we always face.
Completely. And so for everybody who's listening to this, who's thinking, I can do self-custody. Well, what about your uncle? And what about, the company that you may or may not run, and that you would ideally like to put some Bitcoin on the balance sheet. How are you going to do that? So, I think this is a solution for that I think every Bitcoin pleb should be aware of, as part of how we can continue Bitcoin's march into the mainstream by creating the products and services that are necessary to get the mainstream comfortable with holding Bitcoin. And I think this is a better way to do that than just trusting it with Coinbase.
And if you're the sleeper pleb in your business where you're trying to orange pill the board, you now have another, you've got an arrow in your quiver right here. Like, this is
absolutely. And that has been an exciting part of this. We've talked to a bunch of sleeper plebs who work in TradFi firms, or are work for pensions, and are trying to nudge that conversation in their workplaces. And then this model is very appealing, or helps grease the wheels a little bit for those conversations. So if that's you, we'd love to hear from you.
Love it, mate. All right, let's wrap it up. I know this is coming, but if you had one last orange pill left to give to somebody, who would you give it to and why? And I can't remember your other 5 answers you've ever given.
Yeah, I can't even remember what I said last week. I think I said let's push Larry Fink over the edge, because he's had some. Yeah, he's had some Bitcoin friendly points.
I don't know, man. I think he's a sock puppet, but whatever. So
yeah,
so he does need the orange
probably
pill.
right.
Yes.
Yeah, he needs a little help still. Boy, I should have prepared a little bit more for this, but for that particular question. But I'm a circle back to probably the first answer I gave on this, which is because I've been thinking about this the last few days of the geopolitical nature of Bitcoin as we enter what seems to be a new era for Bitcoin, a new chapter, of everyone scrambling to get some, and there's nobody better to try to inspire some FOMO in than Xi Jinping in China, because the geopolitical game theory of Bitcoin is, we're only just beginning. El Salvador is just the pilot case of a tiny company latching onto Bitcoin as a way to juice what they're doing to turn their country around. But the big boys haven't really entered the party yet, and that will be a crazy new development when that happens. And there's no bigger player to inspire the West to react than China deciding to start accumulating Bitcoin. That would be, we'll see when that happens. It could take 10, 20 years, but it'll happen.
Yeah, the gloves would be off then, wouldn't it? It's like,
yeah,
wait, those guys
yeah,
right, buy Bitcoin.
We can't let that happen. We have to do it here.
Or go out and steal everybody's Bitcoin quick. 6102, let's go. 6102.A.
And that frankly that's the scenario that I think is concerning for Coinbase and all these ETFs, because the vast majority of these
crazy
ETFs,
about this whole thing, right? That 13 have filed, I think.
Yep.
I think 10 are listed with Coinbase to be.
Yep. That's a honeypot.
So does that mean? So Coinbase are going to hold the coins on behalf of the companies?
Yes.
But does that also give Coinbase carte blanche over, like, you have to buy through us too, or can they source Bitcoin from other sources? Do you have any idea?
Great question. I don't know. I would guess that they have the option to source it from anywhere, but probably they're going to use Coinbase's desk as their primary. I would guess that's the case.
Yeah, I would guess that's the case too. So then Coinbase, the OTC desk at Coinbase, they just go out to the Krakens and the other exchanges and whatever, and hoover it up from there.
Yep.
But everything going through Coinbase and then custodied is just like
Quite a
Coinbase
single point
goes
of failure
down.
for 6102.
Yeah, but Coinbase goes down all the time whenever we have like huge
Yeah.
pumps. Like, so I think I
Yeah.
tweeted the other day, when on the day that the ETF is released, Coinbase down by lunch. Like it's like you cannot, that wave of liquidity, of the demand coming into to the market. And the other thing, Jesse, that I tweeted the other day that just got a shit ton of interest was, are there going to be circuit breakers placed on Bitcoin ETFs?
Right. I saw something out there that said that ETFs typically don't have circuit breakers. But you might know more about that than me.
I've heard the same. They don't typically have circuit breakers, but the stock exchanges do.
Mm-hmm.
And where are these getting listed? They're going to be some on each one, or are they all going on to the same one? Do we know?
It might be in the docs. I'm not sure.
Okay, so
Sure.
Scenario. Let's say six out of the 13. Let's say we get greenlit. 6 out of the 13 on the NASDAQ. On the NASDAQ, you have MicroStrategy, you have Riot, you have all of these other Bitcoin mining companies that are exposed to Bitcoin. Now, what's the circuit breaker on the NASDAQ? Because if all of a sudden, we know Bitcoin can pump and it can dump, right? So is the NASDAQ going to end up following the beat of the drum of the Bitcoin price? And these companies, because if we get a surge, these companies look at MicroStrategy the other week. It just went absolutely bananas. So the NASDAQ is going to get triggered on circuit breakers on the back of huge price swings in the Bitcoin price in dollar terms. Meanwhile, the plebs are just sitting there like stacking away.
Right. Just on superior rails, because
stock markets closed again, Bitcoin ETFs are closed again, but you can't access anything like MicroStrategy again. I don't care. I'm just stacking quietly over here in the corner.
It's the advantage of a 24/7 monetary network versus going with like what's fundamentally like a database running on servers. That's just 20th century technology and has business hours.
Yeah, business hours as well, with holidays. It's crazy to me that anybody with a decent chunk of cash is just sitting on their hands, fingers crossed, waiting for an ETF to get greenlit so they can buy Bitcoin, like on their brokerage account. It's like,
and the reality is that's where all the money is historically. And here's the system that's going to increasingly eat the value that from this antiquated system. But this is part of how that happens. I think, we get connected to that system. And then that, it's a Trojan horse. It's a Trojan horse for Bitcoin adoption. I'm optimistic that the ETFs, bring in a whole bunch of new capital and new individuals to learn about Bitcoin. And then they realize, oh, this is great. This asset is incredible. And a whole new slice of people will go down the proverbial rabbit hole as they learn about this asset that they're buying to include in their portfolios because BlackRock is doing it. So,
fun times ahead. And by the time that this gets aired, all of this will be like,
it'll probably all be out.
All right, mate. If anybody wants to reach out for whatever reason, if there's a way that they can add value to you or they're interested in your service, where should they go?
So onrampbitcoin.com. You can check out our website, see our products there. And just reach out to us. You can send us an email at hello@onrampbitcoin.com, or, go to our website and then click the button there, contact us. And we'd love to talk with you about your circumstances, just, whether that's because you're excited about what we're doing and want to connect us to somebody or some company, or because you're curious about whether this solution could be a good way for you to sleep better at night by diversifying how you or your family or your company is holding its Bitcoin.
Cool. Thanks, man. Thanks for everything you're doing. Thanks for all your writing. Thanks for the podcasts that you give up your time for. And you've got to shill your own podcast.
Yeah.
This is what a noob you are. You're not shilling your own
Yeah.
podcast.
we got a lot of things going on. So Andy Edstrom is leading our latest podcast, which is Scarce Assets. And the idea of this is a Bitcoin podcast for wealth managers, talking about the concerns, considerations that wealth managers, whether you're a CFA or maybe running a family office, those concerns, considerations about allocating your portfolio to Bitcoin and scarce assets in general. So, the framing of it is that wealth managers know about stocks and bonds, 60-40 portfolio, but there's this zero there for scarce assets that, and that's what needs to change in order for wealth managers to outperform their peers. So it's a Bitcoin podcast all about that topic and those related topics. And we just had our first episode with Preston Pish. So it's Andy Edstrom, me kind of riding shotgun, and Preston Pish came on the show and actually said some pretty awesome and bold things about Bitcoin and how it plays into value investing and what it does to value investing in particular.
Mm-hmm.
So check out that episode, available on our podcast stream for Onramp, and you can find it on our website at onrampbitcoin.com too.
There's an old dude out there, thinks he's a value investor. I can't remember his name, Warren Buffet or something like that. You should send him the clip.
I'm sure he'll put that at the top of his to-do list.
Yeah.
Warren Buffet.
All right, brother. Take care. Great to chat again, and thanks for everything that you're doing. Speak again soon.
Likewise. Looking forward to next time.
See you, mate.